Well, yesterday, the Mark Carney government presented its first federal budget aimed at boosting the Canadian economy, reeling from the tariff onslaught of Donald Trump. But how does it affect individuals? We're joined now by Jamie Golombek, Managing Director, Tax and Estate Planning at CIBC Private Wealth. Jamie, thanks very much for joining us.
My pleasure.
Now, you had to get into the weeds, into the details of this. What are some of the most notable tax planning changes you noticed in this budget?
Yeah, well, we've got a document that's over 400 pages, and there's
reading.
not a lot of major tax changes in terms of telling Canadians about. I mean, there's some things that we were looking for, some things that weren't there, but just a few things that stood out. Certainly on the personal side, no changes in tax rates. They did fix a minor problem for individuals when the government lowered the lowest tax bracket from 15% to 14.5% July 1st, going to 14% next year. One incidental a problem with that is that if you had a lot of credits, non-refundable credits, like medical expenses or tuition, the problem is the value of those credits decreased. They actually fixed that with a special top-up credit so that no individual will actually be worse off sort of under the new system. So that's sort of a minor change. And then they've eliminated a couple things that were sort of a nuisance in terms of, let's say, luxury tax. So you can go out and buy your boat or your airplane right now and don't have to worry about paying that. They've also removed the federal the underused housing tax, which applied to non-residents. So a few positive things there.
All right. So you buy the plane, I'll buy the boat. How does that sound? Now that we can afford it. Okay. What wasn't there? You said you were looking for, expecting some things and maybe you didn't see them.
Yeah, one of the biggest things that a lot of us have been lobbying for, actually for years, is changes to the RIF minimum, so the Registered Retirement Income Fund. So that's really the continuation of the RSP. When you're 71, the end of the year you turn 71, you must convert an RSP to a RIF, and then there's a requirement to take out a minimum fixed percentage starting around 5%, going as high as 20% based on how old you are. So the Liberals did promise in the pre-election campaign that they would actually reduce the RIF minimum for this year by 25%. There was actually no mention of that whatsoever in this 400-page document. And this is part of a much broader issue. Many experts, including the think tank, the C.D. Howe Institute, have recommended that the RIF minimums need to be changed. In fact, maybe we change the age in which seniors are forced to withdraw money from 71 to maybe 73. Maybe we reduce the factors, because the problem that exists right now is that you've got seniors that are relying on that RIF to sustain them through longevity, and they're being forced to take out money and pay tax before they actually need to spend that money. And the problem is that some people could run out of money, and that is the sort of concern. So the government's haste to collect their tax revenue, which they will get one day, certainly on death, has really taken over here, and a lot of people were looking for that, and there was complete silence, no mention of it whatsoever in this budget.
And how much does that bring into the coffers for the federal government, you know?
Yeah, again, so there's various estimates out there. I haven't seen the costing specifically on what it would cost to delay that further. Remember, in the end of the day, it's a timing difference in almost every scenario. The government eventually does get their money at the end of the day, because when you die, on the last to die of, let's say, spouses or partners, the money is ultimately taxable, and often taxable at a much higher rate because of the progressive tax system. So the government gets their money. They may get more money, but they don't necessarily get it right away. And therefore, there is a bit of a timing difference there. But this is something that a lot of people have certainly spoken to us about, and that would encourage people to rely on their own resources for retirement rather than, let's say, more relying on government services.
Okay, and I didn't hear a lot of talk about this, but there's some new rules around short-term rentals.
Yeah, I mean, not specifically on the tax side. So one of the issues with short-term rentals, of course, is this whole issue of renting it out, business income, and ultimately, is it legal or an illegal short-term rental? If there's an illegal short-term rental, one of the changes that they made, and not in this year's budget, but in prior year's budget, was to actually limit your deductions. In other words, you have to still report the income from your short-term rentals, like an Airbnb or something like that, but you're not allowed to write off expenses. So it's very important that people that do have short-term rentals, that they are legally allowed to be there based on zoning, and otherwise you're going to have a problem when it comes to write-offs.
Okay, and capital gains inclusion rate unchanged. So what does that mean for Canadians with assets and investments? What should they be looking for?
Yeah, so again, we know that there was a proposal last year to bump up the inclusion rate. The inclusion rate is the amount of the gain that you must include in your income. So it's 50%. It's staying at 50%. It was supposed to go to 2/3. That was a bit of a mess. That was changed in January of this year to remain at 50%. So I guess investors are comfortable. There was no mention of that really in the budget. A couple of consequential changes to that for business owners. For example, they've eliminated this Canadian entrepreneurs incentive that was supposed to kick into play in 2025 to reduce the capital gains tax rate further on the sale of a qualifying business. Basically said in the budget that given that the capital gains rate itself is not going up, they're going to scrap that incentive altogether. Business owners still, though, have the opportunity to take advantage of the lifetime capital gains exemption, which now exempts $1.25 million of capital gains on the sale of a qualifying business, farm, or fishing property. So bottom line, capital gains still 50% taxable, the lowest form of tax on investment income in Canada.
Okay, and also personal support workers, there's some changes for them.
Yeah, so PSW is a big part of the economy, certainly very helpful to many, many millions of Canadians. They've introduced a new personal credit. So remember, credits are at the lowest rate, 14.5% this year, 40% next year. And this will be available to personal support workers. They'll be able to claim up to $1,100 of a credit. It's actually a refundable credit. This actually starts next year in 2026. It is temporary. It goes from 2026 to 2030. But this should help in terms of their tax liability starting next year.
Okay, and then last but not least, I guess, is the fact the budget's now going to happen in November moving forward on a regular basis, at least until they change it again. And what should people be aware of with that? What kind of an impact does that have? And it just kind of sum up, what's the major changes that people need to be aware of?
Yeah, so I think, look, moving to November does fit in closely, certainly with individuals' calendar year end. So if there are tax changes that are going to come for January 1st of the following year, now you've got the announcement sort of in November, and you've got 8 or 9 weeks to prepare for that, depending on when the budget comes out. So I think people will start looking towards this. So towards the end of the year, we're going to get a budget. We may know what's coming into play on Jan 1st. So gives us, still not as much warning as we had back when it was sort of in March, April, but it still gives us time to look at our year-end tax planning. I think the major message that I would say for individuals is not a lot of changes here, a few small things here and there, but ultimately it's sort of a, ready as you go. A couple of positive things for business owners, particularly for manufacturing and processors. If you're in that business, you potentially could have a 100% write-off if you buy a new building, but very limited application on that.
Okay, Jamie, we're going to wrap it up there. And I just want to point out your report also, you took the picture on the front as well. So you did everything for the taxes on that. Jamie, thanks for joining us today.
Thank you.
Jamie Golombek is Managing Director, Tax and Estate Planning for CIBC Private Wealth.